and we just want to welcome everybody in to this month's webinar. My name is Clarke Holt, and I'm a wealth advisor with Elevate Wealth Advisory, and I have been with this firm for 19 years. Prior to that, I was with Smith Barney, who is now Morgan Stanley, for 4 years. And so I've been doing this quite a long time, and I love what I do, and I have a passion for helping people and just giving personalized financial advice and planning. And I have two daughters, Claire and Caroline. Claire's 15, Carolina's 11. And so, certainly that's one of my, that's something I'm very proud of. And just a little bit about me. I love to exercise, play tennis, spend time with family, travel, things like that. So, and just active in the Athens community. So today, what we want to talk about is big picture, the way we investments in general, markets in general, and kind of give you an overview of the things that we adhere to as far as philosophy, how markets work and things like that. And as we go through these slides, certainly I welcome questions, and I would ask if you can just wait and maybe ask questions at the end so that we can get through this presentation. And if anybody needs to break away, they can certainly. So bear with me real quick. And I'm going to jump to the presentation. So everybody should be able to see this first slide. There's a world of opportunity in equities. And we are doing a new weekly episode, if you will, each month leading up to each webinar that has a lot of these slides and really kind of goes right along with each of those episodes are called Wealthwise. And that just goes right in along and lines up with our webinar for that month. So you may have seen these before. If you're a client of mine, you've maybe seen these slides before. I like to share these. If you've been to a presentation in the past, you've probably seen these as well. So, but they're very interesting to look at. And so we want to kind of take you through some of these. The first slide is essentially, it's just a look at the investment landscape as far as stocks are concerned, or equities. So this is not bonds or fixed income. This is the world investing landscape of equities. And the percentages that you see are the market caps of those countries. And so this is sort of our landscape when we build portfolios and what we pick and choose from. This is not how we allocate necessarily. This just represents, again, by country, the market capitalization of that country. And market capitalization, if you just want to break it down in something to something real simple, it's the number of shares outstanding for one company, let's just say Apple, multiplied by the share price. And so all public companies have shares that are owned by the public. And it could be individuals, it could be pension funds, things like that. And so this is just an aggregate view of all the companies in a country and what that market cap is. So you can see there's lots of opportunities out there. Now, when we talk about equities, we want to look at the areas that can offer higher expected returns over time. And when we talk about stocks, we have to identify these areas we feel like, and again, this is based on research that's gone back to the 50s and 60s, and even before in some cases. We know if we look at this first one, market, that the stock market will outperform the bond market, or stocks will outperform bonds. And that's sort of a given. The other ones are not so obvious. And we go through these, the second one, company size. Small companies tend to outperform large companies over time. Not every single year, but over long stretches, there's a premium that you get in return from owning small companies versus large. The next one is relative price. And that's the price of a stock. And is it a fair price? Is it a decent price? And so value stocks, which could be, you could consider stocks that are inexpensive compared to growth stocks, which could be stocks that are maybe overpriced or maybe expensive. There's a premium that you get by owning value stocks over growth stocks over time. Again, these don't show up every single year, but over 5, 10, 20 years, there's a trend that you do get that higher expected return. And the last one is profitability, high profitability versus low. And that sort of makes sense as well, or it should at least, but there is research that shows, and the data shows that if you lean that way, you will get higher returns versus low profitability. So these four things, or these four dimensions, if you will, are the areas that we want to pay attention to focus on, to emphasize, if you will. Another way of looking at this and sort of breaking it down is we start on the left with the market, and you can see all those gray dots. And so just looking at the market is one thing. And we certainly, that's where you have to start. But as we work our way towards the right of your screen, and we look at, the first one is company size. So you can see at the bottom of that box, there's some yellow or golden circles. So we've identified that there are, in the market, there's a segment of small cap companies. And then the third one is relative price, where we want to identify out of that box the companies that are reasonably priced, or what would be considered value. And so now we've done another segment, if you will. And then that fourth is the profitability segment. And so it looks much different if you compare the market on the far right, on the far left, and then looking over to the far right. The way we've broken this down and the things we're emphasizing makes a big difference in returns over time. And it also is very well diversified. So that's always the case. We're just emphasizing those areas that give us that higher expected return. Now, I can't take credit for this slide, but I do like to show it to people. And we talk about market cap and what that means. And so I talked about Apple. Apple right now their market cap is 2.9 trillion. And just to give you some perspective, the entire world market cap is about 72 trillion, give or take. So Apple is almost 3 trillion. And so, Microsoft is certainly very close, and Alphabet, which is Google and Amazon and Tesla, Facebook, things like that, companies like that. And so the reason I want to show you this is the S&P 500, which is the index that we hear about and sometimes talk about a lot, and we read about in the news. It is a market cap weighted index. So that means that the companies with the higher market cap have a much bigger influence on the performance and the movement. So not just performance up or down, but volatility during any given period. And it could be a good thing. It could certainly not be a good thing. And so, because what you see on this pie chart is there are hundreds of companies that have very little representation in the S&P 500. And so while we want to own these companies and all these others, we prefer not to just be in indexes like the S&P 500 simply because of this market cap weighting. And I saw a stat yesterday that Apple today, as of the close of yesterday, has a 7.1% weighting in the S&P. That's the highest of any company ever. And you have to go back to Exxon back in the mid 2000s, I think was around 5%. And in 1999, Microsoft was around 4.5%. And in 1985, IBM was about 6%. So Apple now is 7.1%. And so it has a major influence on the performance of that index. Now, this is a quick slide looking at market returns and how they're distributed. So to give you this is the whole market. This is not one index. This is the entire US market from small to large, value growth, high profitability, low profitability. It's everything. And each box, the blue obviously are the positive years, the red are the negative years, and the return is actually, along with the year, is actually in each box. And at the very bottom of this chart, you can see the sort of the range of returns, where in the very center, it's 0 to 10%, and then we move to 10 to 20%, 20 to 30, so on and so forth. So you can see the range of returns. You can see each year and what the return was. But the point of this is that most of the time, the market is in an upward moving transition, and it's punctuated by these temporary declines. And since certainly there have been some significant declines, but this gives us confidence. I think this gives us a lot of peace of mind knowing that over time, and this is since 1926, 75% of the time you experience a positive return. And the returns they're sort of a little bit more concentrated towards the middle. So they're not terribly wild as far as the numbers go, just to the downside or to the upside. So this, again, gives us some peace of mind and confidence as we go through market cycles, as we experience the things that we all do as investors over decades. This is a quick look at the market's response to different times where we've had a crisis. And this particular example is a 60% stocks, 40% bonds mix, if you will. So a 60-40. And it's looking at the cumulative total return. And so, you go back to 87, you look at 89, and then some of the events there, the savings and loan crisis, and then the dot-com crash of 2000. Of course, we had the 9/11 attacks, the 08 crash, and the recession there. And in each case, the market reacted in a way. Sometimes it could be not as swift or maybe not as negative, but there are times when we do get these big drops. And just within the first year, or maybe right off the bat, but 3 years, if you look at 1 year or after 1 year, things sort of settle down and maybe kind of turn back positive. And if you look at 3 years, which is the yellow bar, things are obviously looking more positive in each case, in almost each case. And then after 5 years, in every situation, there's a positive return. And the point of this is staying the course is better than having some sort of knee-jerk reaction or deciding to shift or move into a safer environment until the all clear, because we never know when that all clear might be. And the market does its own thing. It has, it's its own animal. And so we have to capture that recovery, we have to stay invested. And if we don't do that, then we miss return. And that's important. This is a look at the S&P 500 index and looking at returns by calendar year since 1980. And I like this slide because it shows what it's designed to do is it's trying to show that in any given year, there are drawdowns. There are big drawdowns sometimes, but most of the time, the result for that year was positive. And so the stats are this, again, from 1980 through 2020. The average decline during the year, at some point during that year, was around 14.7%. However, out of the 41 years, 34 years, the market was positive. So at that time, when the market's down at some point 15%, maybe 20%, we feel nervous, anxious, and we feel like maybe there's not a chance for a positive return. But this actually shows that there is. And there's, again, goes back to that slide prior where the market is in this long-term upward trend punctuated by these temporary declines. So when we see the market down 15% in 1 year, that's actually the norm. And so that's normal. It helps us, again, be more comfortable, have more confidence in what we're doing, and just getting through that period is a lot easier by looking at things this way. This is, again, looking at the S&P 500 and looking at the return in January and then the next 11 months. And so the red dots are the January return. And then the blue bar that you see is the subsequent 11-month return from February through December. So there's really no predictions you can make based on the January return. And it can certainly start off the year. If it's negative, you feel lousy, or you feel like you're going backwards, or you feel anxious, or whatever the case may be, depending on what the market's doing. But knowing that that has no impact on what the market's going to do that year. And also knowing that at some point, probably that summer, maybe that fall, the market might pull back 15% or 20% and still could end the year positive. So again, when you break it down and sort of dissect the way we look at things or the numbers, it does give us, again, that peace of mind. And when we talked earlier about if we react, what do we miss? And say, in this slide, we'll shed some light on that. This is the S&P 500. Again, we do use that index as a sort of a benchmark, if you will, but also a tool just to show comparisons and things like that. This is the S&P 500 from 1991 through 2020. And what you see at the bottom is the annualized return. And from the left going over to the right, we've got the growth of $1,000. And so if you stay invested the whole period, you end up with $21,100. And then we look at the next column, and it's, what if we miss the best week? Just what if we miss that best week during that period, or the best month? And then we keep going to the best 3 months, the best 6 months. So depending on if you have this type of reaction, and most of the people I think that have these reactions are probably people that are doing this alone or by themselves without a professional. And so it creates obviously a big gap in the wealth that was created. So going, if we just look at if you just miss the best year, your 1,000 instead of 21,000 is actually 12,000. This makes a huge difference over multi-decades. And when we talk about investing years, retirement years, that is a multi-decade period. So missing these days of strong returns can hurt our performance. This slide looks at different asset classes or indexes for a period that was, I think, very unique, where there was a lot going on. This is actually the decade of the 2000s. So January of 2000 through December of 2009. Again, we had the market run up to 2000 was huge back in the late 90s. There was a lot of internet stocks, and there was this big bubble, if you will, in the market. And then we had, again, 9/11, we had the Iraq war, we had interest rates all over the place. We had the crisis in 2008, where, companies were going, like Lehman Brothers, were going bankrupt. And, it was a decade of, I think, lots of different events, negative events, if you will, and certainly a lot of positive as well. But this is a good example of, even in a time or a period where there are lots of things going on that make us feel anxious or that make us worry, there are asset classes or areas of the market that actually performed well. And so the far left, the S&P 500, actually had a negative return for that period. And we see that it was, cumulative, it was down about 9% for that period. And then as we work our way over towards the right, from left to right, we've got small companies, US large value, real estate, international value, international small, emerging markets, and in going into bonds towards the far right. So when we build portfolios, we want to kind of go back to that investing landscape slide, if you will. We want to look around the world. We want to look at the areas that offer, based on science and research, or based on financial science and research, the areas that give us the best chance of having a positive return or a successful experience, but again, that give us that little premium, that little edge. And we never know which asset class or area that will be. So we have to have each piece in the mix. And that's important. And so again, this slide kind of is a testament to that. This is a quick look at equity returns of developed markets since 2001. And I show this because we call this sometimes a Skittles chart, or maybe a patchwork of colors. That's sometimes what I tend to use. And that's essentially what it is. It's a patchwork of colors because the returns are completely random. And there's never a way to forecast or predict where the returns will come from around the world. So we want to have exposure to all of the countries, with the right emphasis on obviously the more, like US, for example. We certainly like to overweight US, but having exposure to these is very important. And returns can, again, come from anywhere, and being this diversified is very helpful. It balances out the ups and downs. But again, looking at it this way gives us some idea of what to expect. I mentioned earlier that the total world market is about 75 trillion. I think I said 72 trillion. And this was as of December 2020. And it was 75 trillion. I think it probably dipped at some point in a little bit in 2021, maybe not much, and then went back up. And so, well, I'm sorry, 2021 was quite a year. And then the beginning of 2022, obviously there was a little bit of a hiccup. And so going into certainly into the Russia-Ukraine situation, things like that. So we're probably around 75 again, if you will, maybe a little higher. And out of that, about 3,600 is US, and 7,418, around that number, is developed outside the US, so developed markets outside the US. And these are number of stocks or companies. And emerging markets about 8,800. So you're right at 20,000 different companies around the world. And again, we want to be invested everywhere with the right emphasis. And so this is important. This slide reemphasizes the previous slide. The market, the size of our world markets, US is around 55, 57%, international is around 30, and emerging markets is about 12.8. And so a lot of the so-called experts or sort of people that do predict out maybe out a 10-year period or 20-year period are saying that US will begin to shrink somewhat as international grows. And so that international number, that 30% number at the end of 10 years, is projected to be higher. That just makes sense as there's global growth and companies around the world are successful and doing well. So a look at the bond market is a little bit different than looking at the equity market. And so our first slide showed that investing landscape in equities. This slide shows the investing landscape in fixed income. And it's a lot different. It looks a lot different. Whereas, the equity side, US was around between 52, 55, 57, somewhere in there. And in the bond market, we're only 29% of the total world market of what we would call the opportunities that are available. And it's much more spread out. And the bond market's actually larger than the equity market. And so there's lots to choose from. Again, you want to be globally diversified here as well. And there are certain areas that we emphasize within fixed income, like high quality, shorter term, things like that, that help balance out our portfolios. And as people may or may not know, that, you know, bond prices are directly, they're inverse to their interest rates, or to interest rates in general. But as we look at, when we look at bonds sell for usually a par value price of 1,000 per bond. And as that bond, you know, that bond price can fluctuate depending on the yield of the bond, or rates, if you will, interest rates. As the rate goes up, the price of that bond can go down, or will go down. If rates go down, the price of the bond will go up. And so there's this inverse relationship between the two. Not that people, you know, necessarily pay attention to that or need to know that, but it is important to know, because bonds aren't guaranteed. They are, you know, there is some movement, there is some price movement there as well, as far as the value of our bonds. And just touching on that real quick, when we know this, a lot of us know this, and some of us may not think of it this way, but when we invest in stocks, we own a piece of a company. And this is sort of the way we've all understood investing in stocks, is if we buy 1,000 shares of Apple, we own a piece of that company, shares in that company, and then we sort of participate in the success, if you will. With bonds, we actually are loaning our money to a company, or to a corporation, or to a government, and they're promising to pay us an interest rate. So it's a little bit different. So in a sense, bondholders are lenders to a company, and stockholders are equity owners. And they each have their place in a portfolio, if you will. Bonds help dampen the volatility, can be a liquidity tool, can be an income tool, things like that. So when we look at the dimensions that I talked about earlier, we take the market, and this kind of goes along the same lines as a slide earlier. And we want to look at the entire market, obviously, of the thousands of stocks that are available. And this goes for US, non-US. And we've got the research and the financial science that identifies the areas that have higher expected returns. So this research has been going on for decades. So what we do, and what we feel like is important, is we want to overweight or emphasize those areas that offer higher expected returns, and then underweight the rest of the market. And this allows us to, again, to get that higher expected return, or what we call a return premium, over time. And I think the important thing to remember is this return premium, or this little excess return that we are looking for, it does not identify itself or show up every single calendar year. There will be periods, sometimes rolling periods of 5 or 10 years, where there's not a premium. And then all of a sudden there is again. And so, but the longer stretches that we look at, if you look at this for 20, 30, 40, 50 years, there is no question, and there's the probability of it happening, or usually in the 90s, 80, high 80s or 90%, that these areas will give us that premium. And so that's how we like to stay invested. We rebalance along the way to keep the overweight, and the underweight, and also the bonds and the allocation to stocks and things like that. So a well-diversified portfolio can emphasize these things, and that's very important. We've all probably seen a slide like this before, where this is about investors' emotions. And I would say it is really hard to get people to invest when there's fear and anxiety and there's market declines. It's very easy to encourage people, and maybe get people to commit, if you will, to investing when the market's high. And it's almost the complete opposite when we shop. When we shop, we look for deals, we look for discounts, we look for better prices or a price match, as Best Buy would say. But in investing or with investing in stocks, it's the opposite. We tend to be more comfortable buying when the market's done really well because we want to participate in that. We see that happening, and we're very nervous or very fearful of doing so if the market's down. But this is the cycle of emotions we go through: optimism, elation, nervousness, fear, and then optimism again. And I think the theme would be, there's always, really the only reality is there's optimism. And so that's essentially, if you look at what the market's done and you look at history, it points to, we have to be optimistic at all times. And we want to remind people that working with an advisor, and creating an investment plan, a personalized investment plan that fits your needs and your risk tolerance, and then we want to structure portfolios along those dimensions of expected returns, globally diversify. We want to manage our expenses and our turnover, which helps with taxes, and be very tax efficient, and stay disciplined, stay the course, and stay committed. These are all the things we have control over. We have direct control over all these things. We do not have control over what interest rates are doing, who's president, what markets are doing, what's going on around the world. But focusing on things we can control gives us a much better chance of having a successful, positive experience in the long run. That wraps up the presentation for today. And so again, I know we may have some questions, so I wanted to open it back up to anybody that's got a question or a comment, and certainly if you're more comfortable using our chat feature, you can do that, or just, I can give you my email address and you could email me directly at any time. And I know we've got people on here now. We may have some people watching the recording later. So I'll leave that email address with you shortly. So any questions before we wrap up? So we've got a question: what should I do with my investments right now, given the volatility? And the short answer is stay the course, sit tight. As long as you're appropriately allocated, and you definitely are if you're working with us, there's no reason to do anything with your investments other than rebalance. And the only time we would make a change, it wouldn't be because of volatility, it would be because of maybe a personal circumstance or a situation, which could be job related, could be life related, things like that. But as far as what the market's doing, the plan that you have in place is designed for this market, and it's designed for markets, good or bad. And the outcomes will be there in the long run. So I will definitely want to let you know my email address. It is Clarke, CLARKE .Holt at elevate-wealth.com. Again, that's Clarke with an E at the end, .Holt at elevate-wealth.com. And so again, reach out to us or your advisor or me directly if you have questions about this or anything else. And we look forward to having everyone back next month for our next monthly webinar, Strategies for Retirement Transitions. And again, these are all recorded, so you can go back and watch them again if you want to maybe go back and if you didn't pick up on something on the way through. But we're glad you joined us. We appreciate it. And hope everybody has a great week, and we will talk soon. Oh, one more thing. Our website again, elevate-wealth.com. Most people have gotten the word, but we did rebrand from Victory Financial to Elevate Wealth, just as a sort of a part of our growth. And everybody's real happy about that and excited. And so again, our website is elevate-wealth.com. Thanks for joining us. Have a good week.